Okay, so Chapter 12, Capital Investment, Decisions, and the Time Value of Money. Capital budgeting it may not be what you're thinking it is. When we think of budgets, we think of what we've learned in previous chapters, learning how to plan for the future, financial planning, guessing or estimating exactly how much you're going to be spending into the future. Capital budgeting, though, and I'm not quite sure why the term budgeting is thrown in there, but capital is about the acquisition of fixed assets. And capital budgeting is really a finance concept that helps financial managers to project into the future or looking at the projection of cash flows into the future and then bringing them in terms of what is the present value of those future cash flows. And so we're going to try to measure how that applies to equipment, plant, vehicles, and information technology. There are four common methods used for budget analysis. There's the payback period, the accounting rate of return, the net present value, and the internal rate of return. We'll go through each one of these and figure out how this all works. We're going to try to look at cash flows as it relates to the acquisition of an asset and how those cash flows will measure over to the future. And then we're going to then try to figure out what today's value is of those cash flows. And then that helps us, it gives us a starting point in terms of what is the right decision. Capital budgeting process there's 5 steps outlined in the textbook. The first is identify potential capital investments. So let's say you want to acquire a new machine to replace an old machine. You're going to estimate the net cash flows, look into the future, see how those cash flows are actually going to materialize, whether it's going to be in the future of 1 year, 2 years, 5 years, 10 years. It could be into a long period of time, but you're going to estimate those cash flows. You're going to analyze potential investments, and you're going to screen out the undesirable investments. Maybe by using one of these methods, you're just going to throw some out that say, nah, that's not even feasible. You won't even look into it further. And then you're going to further analyze using NPV and IRR. So the step 4, you're going to engage in capital rationing if necessary to choose among the alternative investments. And then step 5, perform post audits after making capital investments. When we say post audits, everything that we assumed during the analysis to come up with what decision we made, the audit is really, did that end up being the right decision? And looking at the assumptions, and that way, when we're doing this, we're getting better and better at capital budgeting. We're getting better at taking everything into consideration. There is a certification called LEED. Certification promotes sustainability practices in building and construction industry. We're looking at location and transportation. How does that relate to reducing the amount of transportation? So that helps with sustainability. Sustainable sites, water efficiency, energy and atmosphere, material and resources, indoor environment quality. Okay, the first item we're going to look at is called the payback period. The payback is measuring how long it takes for us to receive our initial investment. How many months, how many years, how long will it be before we put out some cash outflow and then we get that money back? The payback period, the time that it took to get money back. It measures how quickly managers expect to recover investment dollars, and the shorter the payback period, the more attractive. And that being that, we don't mind it putting out some money, but if we get our money back really soon, then we're pretty thrilled with it. We're happy with it. Payback period example, let's say tierra firma is considered a potential investment in energy efficient HVAC system that is expected to cost $240,000. This would be like some kind of a central heating or air conditioning unit. $240,000, that's what the initial cost is. Its estimated useful life of 6 years, so it's going to last for 6 years, no residual value, meaning when we're done with it, it's just scrap. We can't sell it, resell it, there's no residual value. If it had some, we'd be able to resell it, and we don't have any, so. And equal annual net cash energy savings of $60,000. So the way we're going to compute way we're going to compute the payback period is we're going to take the initial investment, $240,000, and then we're going to divide that by the expected annual net cash inflow. In this case, it's $60,000. Now this works because it's equal cash flows. So we can use this. If it's unequal, we can't use this, but it is equal in this case. So we're going to take $240,000 and we're going to divide it by 60,000. 240 divided by 60 gives you 4. That's 4 years. So we can expect to get paid back by this investment in 4 years. Tierra Firma is considered a potential investment in development of a B2B portal. It has an estimated useful life of 3 years, no residual value, and equal annual net cash savings of $80,000. Again, this is relatively easy because it's equal cash flows. So we're going to take the initial investment, $240,000, and then we're going to divide that by 80,000 because that's the savings coming in per year for 3 years. And in this example, we're actually getting paid back in 3 years. So often what you have is a company will have 2 potential investments and they're going to stack them up and measure them against one another and see whether one is better than the other. Now, this is where you'll see how the payback process is real good at letting you know when something is going to get paid back. But there is some shortfalls with it. So for example, payback analysis in HVAC says it's going to take us 4 years to get paid back, right? 240,000 is our initial investment. But we're going to continue to receive savings for another 2 years after that. So you could see that, you know, we'll actually get up to $360,000 savings for a $240,000 investment. Under the payback analysis for B2B, we get paid back in 3 years, which is good in terms of cash flow, but there's no more cash flow after that. So it kind of highlights the weakness associated with payback. If your emphasis is purely cash flow, then the obvious option is going to be the B2B portal because you get your money back sooner than the HVAC, all right? And in many cases, what you have is companies have actually a policy in place that says, look, if we don't get paid back by a certain year or a number of years, then we're just going to scrap it. We're not even going to consider it. So this would be kind of a downside if the policy is such that the company will not consider any investments that has a payback period longer than 3 years. Well, you'd be a go on this because it's 3 years or shorter, right? But it would be a no-go on the HVAC because it has a payback period of 4 years. The payback period can be helpful and useful, especially if you're wanting to screen out certain types of investments. But you can see how it has some weaknesses associated with it. Now, here's another example here where we have unequal net cash flows, unequal, all right? So Tierra Firma is considered a potential investment in new equipment. It has an estimated useful life of 6 years, no residual value. Again, they're not gonna be able to sell it when they're done. And unequal net cash savings as shown below. So they're plotting every year, there's the 6 years, and they're plotting each year how much the annual net cash inflow is. So the first year they take in 100,000, second year 80, third year 50, 50, 50, all the way to the, that's interesting because it clearly says no residual value. But in the example here, it actually drops a residual value of 30. Well, maybe what it means is that, no, it clearly says 6 years and then there's residual value. So I guess it's not really relevant when we're talking about the payback period because we're trying to come up to at what point in time does Terra Firma get their money back from the 240,000 investment. So what you're going to do is you're going to accumulate the cash flows each year. First year's 100,000. That's what you have year to date, or in total, the accumulated net cash. The next year, you take in 80,000, or you're going to add that. So over the 2 years, you have 180,000. This is keeping track of the accumulated net cash inflow. Third year, 50, that's 230. So you're real close after 3 years, but you're still not quite there. So somewhere between year 3 and the end of year 4, the end of at the beginning of year, the end of year 3 and the beginning or the end of year 4, somewhere between 3 and 4, you actually received it. So the payback period is between 3 and 4. After 3 years, there is still 10,000 to recoup before the payback of the 240,000 is reached. So the question is are we done? Are we just, it's not really a 3-year payback, but it's not really a 4-year payback. Okay, so how do we figure out what it really is? So after the 3rd year, let's go back. After the 3rd year, you'll notice that you still had 10,000 left. You still had 10,000 remaining. But in the 4th year, you had 50,000. So you had 10,000 remaining. See that? It's 230 to 240. You had 10,000 still to go. And yet you had 50,000 that came in that next year. So we're gonna essentially take a proportion of that. So it's going to be the 3 years plus 10,000 divided by 50. 10,000 divided by 50, which is 0.2. So 3 plus 0.2 equals 3.2 years. So we had the 3 different options. B2B portal gives you a 3-year payback period. Production equipment gives you a 3.2 years. That's what we just figured. And then the HVAC system, the very first one we looked at, gives us a 4-year payback. If we were comparing these 3 alternatives and we were simply using the payback period, you would choose the B2B because that's the shorter payback period. If that's your criteria, that's all you're going to be using. But you can see the weakness associated, particularly with the HVAC. This is the one that had quite a few cash flows after the fact, and they were ignored because you're using strictly the payback period. So the criticisms of the payback period focuses only on time, not profitability. That's what we just learned by looking at those cash flows. Only considers cash flows during the payback period, ignores cash flows after, which is what I pointed out to you. And then it ignores residual value, okay? So if we're using purely the payback period, what you're gonna do is the investments with the shorter payback period are more desirable, all else being equal. So if there's no other issues, no other criteria besides when you get paid back, then the shorter ones is what you're gonna go with. You can have a situation where a company is desperately in the need of cash flow. In other words, it doesn't have the excess cash to be pushing through for long-term investments. And if that's the case, then naturally they're going to be choosing the investment with the shorter payback period.